Recording. So thanks for joining us today for our fourth and final session in our series on clergy finances. You can find the video recordings of our previous sessions on the Idola YouTube channel. And in this series, we've been exploring a variety of financial topics that may be helpful in your ministry. And today we'll complete our series with our session on clergy taxes. So we're going to be recording the first part of the session for our resource library, and then we'll pause that so you can feel comfortable asking any questions you may have. And we are delighted to welcome Mr. Larry Dresner from Church Pension Group to lead our session today. Larry serves as a financial education client specialist at CPG and is going to help us sort through some of the aspects that we need to keep top of mind when attending to our own personal finances. We are grateful to have Larry here to share his expertise and experience with us. I'll begin today by opening us in prayer, and then I'll turn it over to Larry. So let us pray. Almighty God, whose loving hand has given us all we possess, grant us grace that we may honor you with our substance, and remembering the account which we must one day give, be faithful stewards of your bounty, through Jesus Christ our Lord. Amen. And with that, Larry, thanks so much for being with us today.
Thank you for inviting me here. I always like to talk about this stuff. So just to give you a brief background about myself, I've been with the Church Pension Group just about 8 years now. And I consider myself to be a resource to everyone who's a member of and a participant of the pension plan, a resource in the way that at any time during your career, you can contact myself or my colleagues to ask questions about the pension plan, how it works, see if there's opportunities to increase and maximize your pension. And as you get closer to retirement, help discern when a good time to retire is, how that ties in with Social Security, your own personal savings, and that kind of stuff. So in today's webinar, I'll dive deeper into the taxation of benefits and how clergy taxes kind of works. And if we have time, we could also do a little sidebar into other aspects of the pension plan, because I understand some people who are attending are kind of new to this. So that's great. So here we go. So one of the most confusing aspects of taxes for clergy is that the IRS considers you to have dual tax status. And what that means is you are considered an employee for federal income tax reporting purposes, but for Social Security purposes, you are considered self-employed. So we have a booklet on our website at cpg.org, Guide to Clergy Taxes. It's a PDF, you could download it, and it goes into bigger details about the pension plan and what it means to participate in our plan. And there are a couple of rules that are involved in order to be getting credited service and how the taxes all work. So the first thing is you are considered an employee, so you are receiving a W-2 at the end of the year, not a 1099. That's important to understand that part. You are exempt from withholding. So what that means is the IRS rules say that your employer is not required to withhold federal taxes for you. But most employers, because they're already doing it for lay people, just do it for clergy as well. But what that means is they're paying federal income tax on the cash part that you are getting compensated, but not the housing allowance part. And that may not make sense just yet, but it will. So basically you can't have your employer withhold taxes, or you can do estimated quarterly taxes on your own behalf. So basically what the bottom half of this screen shows is for federal income tax purposes, your withholder can tax your salary based on the tax rate of the income. And for SECA, self-employment tax, you're responsible for their Social Security and Medicare part. So what that really means is this. Your total assessable compensation comes to you in two ways. On the right-hand side, the employee part, you're taxed as an employee. These are most, if not all, of the items that are considered taxable as an employee. Your cash salary, the benefits that are listed here, and then if you have any other consulting or counseling fees outside of your employment. So for instance, if your employer offers you a Social Security offset, that would be taxable. Personal use of a church car, group life insurance, unused portion, all this comes to you as taxable. And this is where your employer can withhold federal income tax on your behalf. Your housing allowance part is where you need to calculate your housing allowance and pay the self-employment tax. Okay, so to dive a little deeper, let's go back to this one page here. Every year we update this guide for clergy tax preparation. This is last year's, but this year's is currently, so it's 2021 for 2022 for 2021 taxes. So you could download this. If you have a tax preparer doing your returns, you should hand this to them. Hopefully they'll say, don't bother, I know all this stuff. And then you know your tax preparer knows what they're doing. But this could always help with some of the smaller details. So let's talk about how to determine what your housing allowance is. When you are employed, every October or November, your vestry has to pass minutes and in there include a resolution that designates how much of a housing allowance is part of your total compensation. Okay, so they typically will ask the cleric, well, how much do you want us to put in for your housing allowance for the resolution for the minutes? So 9 times out of 10, it's up to the cleric to determine what their housing allowance is, and we'll get to that in the next slide or two. But this is an example, if you live in church provided housing, what that resolution could be. And you could actually literally cut and paste this because it works. All right, you just change the names, obviously, and all that, and the dollar amount. But this is a good resolution template housing allowance that you could use. All right, so this is for a church provided residence. Okay. Now, if you lived in your own cleric owned or rented residence, the wording is a little bit different, but again, you can cut and paste this and give this to the vestry for their minutes, and they just have to change the numbers and the names. Okay, so this is an annual thing. Every October and November, that vestry should pass the minutes. But if things get so jammed up where they don't have time to, this is like a safety net language where it says if we don't change it for this year, it carries forward, going forward. All right. So housing allowance. There are 2 ways that you can calculate housing allowance. The first way is the actual cost you incur to maintain your primary dwelling. So basically that just means add up all your receipts for these different categories, and that pretty much is your actual cost. So what could be included would be, if you own a house, it would be mortgage and interest. It would be real estate taxes. It would be all utilities, which means heating, lighting, electric, phone line, as long as it's a landline-based phone, not cell phone, okay? As well as internet access. So that's considered utilities. All furnishings. So if you go out and buy a whole new bedroom set for that year, that could be included in your housing allowance, okay? If you're renting, then it would be just rent, maybe renter's insurance. If they charge you for a garage parking spot, which they do in New York, then that would be included in housing allowance, okay? Again, if you're living in your own home, if you have landscaping costs, that counts, and capital improvements. Now, a capital improvement is not a fresh can of paint on the dining room wall. It's basically to improve the property, which would mean a new roof, adding an additional room, new flooring, something that really improves the quality of the property. So that's a capital improvement. That's all included in what could be designated as a housing allowance for actual cost. The interesting thing to note about, there is no definitive list issued by the IRS or anybody else what's included in the housing allowance. So there are gray areas, and depending on how aggressive or not you want to be with your tax preparation, you could go into those gray areas. But the ones I'm listing now, which is mortgage insurance, real estate, capital improvements, utilities, those are all the generally accepted standard that everybody follows. All right. So that's the actual cost method. The other method is fair rental value, which means if you took your house furnished with utilities and you threw it out there in the market to rent, what could you get for it? So you could use Zillow or other websites that give you that kind of information. If people still read a newspaper and list houses for rent in the newspaper, you can get cut out a listing of a similar house to what you own. So the idea here is to try to get a close approximation of the fair rental value furnished with utilities. And that would be the second way to calculate your housing allowance. Now, when it comes time to do your tax return, the IRS requires you use the lower of the two numbers. Okay. So now that you've calculated these two methods, now when the vestry comes to you in October, November and says, hey, what number do you want to use for the housing allowance? You give them one of those two numbers that you've just calculated. And that's what ideally, that would be the number that they include in the minutes. Okay. Now, what makes things confusing is if you look at how the church pension group looks at housing, they say if you live in a church-owned housing, we're going to say that 30% of your compensation is the number we're going to use for housing allowance number. So that's a placeholder strictly for the use of the pension fund to determine what the housing allowance is based on your total compensation. But you cannot use that number with the IRS. They're just going to laugh at you. Okay. So now we know that you either do the fair rental value furnished or you do the actual cost. And those are the numbers you use in your personal tax return, not that 30% number that CPG uses. Okay. So I hope that's clear. If not, we'll do questions at the end. So just, write down something to remind you what your question will be. So that in a nutshell is going to be the taxes until we get to your specific questions. There's something else I'd like to bring up to you about business expenses for clergy. Back in 2018, when the tax laws changed, the law disallowed employees to get reimbursed for business-related expenses. So that means if clerics use their car to visit a sick congregant, or they're driving someplace else for business-related, or they're buying books or journals, as an employee now, you no longer are able to deduct that on your tax return. So what you might want to think about is what the IRS calls, and it's a mouthful, an accountable reimbursable business expense plan. So basically what that says is you come into an agreement with your employer saying, let's agree on how much I could have as part of my compensation for business related expenses. I will document what those business expenses are. I will submit documentation to you, and you, my employer, will write me a check to reimburse me dollar for dollar. That's basically how it works. So it could be used for travel and other business expenses. It should be paid directly by the employer, or you can be reimbursed through an accountable plan. So the IRS does have a book that you could download from their website, how this works. So basically you have to document the usage and explain what the purpose was for. If you submit a restaurant bill saying this is a business related purposes, the IRS is going to say who was there and what was the business purpose of the meal. Okay. They also require that you submit the reimbursement within 60 days of incurring the expense. So again, if your employer then cuts you a check to reimburse you, it's not taxed as income, it's not reported to the W-2, it's totally legit, just between you and your employer. So what I often advocate is you would have a separate credit card that you use strictly for business purposes. So that way you could just hand the monthly receipt from that credit card to your employer, and they will cut you the check based on that. So it's important for you to have a conversation with the employer, what expenses they consider would be valid, so that you don't submit something that they're going to say, is that really a business expense? So some of the business expenses here are, it must be necessary or to enhance your job as a cleric. And this is just a list. It's not exhaustive, but it gives you a good idea. Books, magazines, professional organizations, like if you're required to join the local chamber so that you meet and greet and get people to know you, and you could, bring them into your church, that could count. Other similar organizations. Continuing ed is a big thing. I mean, you need to continue, your education, so that could be a business expense. Meals and entertaining with a clear business purpose. Non-commuting transportation. We'll get to that in a little more detail in just a second. Business use of a cellular phone, cost of purchasing and dry cleaning your clerical garb. So for men, that doesn't mean a business suit. It's got to be, the collar and the robes, that kind of thing. Business use of a cellular phone. Most people don't have a landline anymore. So they may have a group plan for the cellular phone in which they're using both personal and business calls. So it's going to be up to you, and I think it's a good idea, to figure out, out of that total business, out of the total cell phone bill, probably 60% is family and friends, and maybe 40% is only business. So that would be then what you would agree with your employer to submit to reimburse just the business part, the 40%. Okay. Non-commuting transportation. Traveling from your home to business is not a deduction. Business to business is a deduction. So if you're already at your church and you go visit a congregant in the hospital, that's from work to another work, so that counts. But if you went from your home to the hospital because that's home to work, that doesn't count. So you need to be mindful of that, okay? So again, this is not an exhaustive list, but it gets you close. And I'm sure that your tax preparer could also advise you if there are other areas that might count for business expenses as well. Let's talk about interim positions, for how the housing allowance works for that. If your interim position is for a period that lasts for more than 1 year and requires relocation, then that residence that you move to is considered your primary residence for tax purposes from the first day of that position. If the position is for less than 1 year, then your original primary residence and home will be the home you use your housing allowance on for that. So this is actually an IRS kind of rule for travel purposes, what's considered your primary residence and what's considered interim residence. Okay. So in this example, then, if your primary home is going to be used for your tax purposes, then you may have reimbursable business expenses for traveling and the meals, and if there are tolls, that kind of thing. All right, if you purchase any materials for that. So in retirement, federal taxable income, your cash salary, or if you work after retirement, and we could always talk about that, how the pension plan, deals with that. Your pension payment. So what that means is that at the end of the year, you're going to get a form called the 1099-R, R for retirement. And that's going to show you how much you received from us for your pension. If you have the RSVP distributions, which is just a fancy marketing name for a 403B plan, okay? If you have distributions from the retirement plan and the RSVP distributions, that could be taxable, but we'll talk about some of it may be eligible for housing allowance. If you have a traditional IRA, Roth IRA, Social Security may be taxable, any other self-employment. So this is all taxable income in retirement. Well, let's talk about how the housing allowance is applied. You have that housing allowance exclusion through your entire career and through retirement, all the way to the day you pass. So in retirement, you no longer have a vestry resolution asking you how much is your housing allowance. CPG does that for the retirees. So in November, December, the board at CPG will pass a resolution that basically says 100% of the pension is eligible to be declared as housing allowance. It's up to the clerk and their tax preparer to do the math and figure out how much housing allowance they have and how they apply it to the pension plan. So we're saying it's all eligible to be declared as housing allowance. Okay. That also, and we also say that the money that's sitting in the RSVP plan, R403B, is also eligible to be declared as housing allowance. It'll be up to you to determine how the numbers work on your personal tax return. So that's cool. And one reason why you might want to consider contributing to the 403B plan, that again, we call the RSVP, because the money goes in tax, pre-tax, right? It grows tax deferred. And you may have the ability to have it tax-free on the way out if you could apply housing allowance towards it. That's like a triple win. Okay. So basically what happens is when you do your tax return, one of the questions on your tax return is how much did you receive in pension, distributions, IRAs, all that stuff. You plug in that number. And then the next question on that tax return is going to be, well, how much of it is taxable? That's where you back out the housing allowance amount, and whatever is left, you carry over, and that's what gets taxed at the bottom of the page on your tax return. Okay. So something interesting to note that is, if you are married, filing joint, The cleric has that housing allowance through retirement, but if they designate their spouse or partner to be the beneficiary of their pension when the cleric passes, that housing allowance goes with the cleric. So now the pension is going to be taxable to the surviving spouse because the housing allowance went with the cleric. So that would be something to plan for down the road. You know, you have the taxes available to pay for that pension that you're now receiving as a survivor benefit option. So this is just a summary now: federal income tax exclusions in retirement. The housing, we talked about the fair rental value furnished plus utilities, or the lower the actual cost spent. Okay. If you're working in retirement, then you need to obtain a separate housing allowance resolution from your employer. And if we have time, we could talk about how the pension rules play with that. Benefits, you have, as of today, you have a Medicare supplement subsidy plan. It's called a Medicare Advantage plan. So that means at age 65, when you're on Medicare Part A, Part B, depending on the years of credited service you have with us, we will subsidize the cost of the Medicare Advantage plan. So one of the magic numbers is 20 years of credited service. As of today, the way the plan is written, if a cleric retires with 20 or more years of credited service, the Medicare Advantage plan would be free to both them and their partner or spouse. That's as of today. That's a huge benefit, big cost savings, right? You also have $50,000 of life insurance in retirement. So we touched briefly on a lot of this stuff. Could always do a deeper dive, and just to give you an idea of some resources we have here, you can certainly stop by our offices in New York anytime you want, as long as COVID rules allow it. You know, client services, that's the phone number on the left-hand side, along with the phone number and their email. So what you could do is you can call up and say, I'd like to have a financial conversation, at which point you can make an appointment to speak to myself or my colleagues, and we could have a one-on-one phone conversation to talk about the pension, about any strategies with regard to maximizing your pension, some of the other benefits that we could talk about the pension plan, finances, Social Security. That's free. It's there during your entire career and even in retirement to have these financial conversations. We have a toll-free tax hotline with 3 CPAs who live and breathe Clergy Taxes. You can call them at any time during the year to ask your tax-related questions when it comes to clergy. And that tax guide hotline, the tax booklet, is updated every year, available as a download on our website. Okay. Other resources, if you don't have a tax preparer who understands clergy taxes, ask your colleagues, see if they could recommend someone. Maybe the financial officer of your church or of the diocese could recommend 1 or 2 people. You could interview them, make sure they understand what clergy taxes are all about. Okay. Tax resources, Richard Hammer writes an annual guide to clergy taxes that is literally 2 inches thick, and it goes in super duper detail, much more than most people care to know about. We do an Episcopal distillation of it, which is the second one, the 2022 tax guide for Episcopal ministers. So we reduce everything that Hammer writes and reduces it and adds some items that are unique to the Episcopal Church, and that's downloadable from us, free every year, updated every year. Okay, and that's all available at cpt.org/taxpubs publications. And this is basically just a disclaimer that says everything I said at this point is meant to be educational purposes. And if I got something wrong, the church plan supersedes anything I said. So some things I could digress a little bit on. It's important for ordained clergy to every couple of years check on the Social Security benefits that they are accruing. And what I mean by that is you need to have 40 quarters or roughly 10 years of working and paying Social Security to start receiving their benefits. But where things get interesting is Social Security may not always get the numbers right for what an ordained clergy earned in any particular year. And the reason for that could be, well, there are basically 3 reasons. One reason could be maybe the bookkeeper at your employer didn't fill out the form right and did not report it correctly. or the people down at IRS and Social Security didn't know how to read the form correctly, or the personal tax preparer just didn't do the taxes correctly. So every couple of years, it's a good idea to log on to the Social Security website at ssa.gov and review the salary history they have on record for every year you've worked. So to give you an example, let's say you're making $60,000 a year and you're declaring $20,000 for housing allowance. If Social Security thinks you made $40,000 for that year, they're wrong. They should be thinking you made 60, okay? Because your housing allowance should be in there, but they didn't, it wasn't reported correctly, or the tax preparer didn't prepare correctly, or the person's down in Social Security didn't read the form. But the point is, if they're wrong, you do have the opportunity to correct it. I've had clerics go back 40 years to correct Social Security. You can't go back to day one for Social Security purposes to correct their information. You could only go back 3 years on correcting your personal tax return. Okay. So just as a, every couple of years, 3 or 4 years, just log on to ssa.gov and see where they got reporting. So, if something is wrong, you can catch it early. Saves a lot of aggravation than having to go back 25 years and correct it, right? So that's one trick. Something else is for clergy who are not yet or newly ordained, let me say, you become vested in the pension plan with 5 years of credited service or turning age 65. So if you only have 1 or 2 years of credited service now, and let's say you have to step away because you're raising kids or you're taking care of your elder relatives, you could always come back and continue and pick up where you left off. But again, you don't become invested until you have 5 years of credited service in or turn age 65. Another milestone year when it comes to the pension plan is 10 years. Once you receive 10 years of credited service, you are eligible to start receiving subsidized payments to defray the cost of the Medicare Advantage plan. So what that means is, we had said that at 20 years of credited service, as of today, the way the plan is written, the Medicare Advantage plans would be free to both you and your spouse. So anywhere from 10 years to 20 years, you would get a subsidized rate. As you get closer and closer to 20 years, we subsidize more and more of it. So when I have conversations with clerics who are at 18 years, I'll say, hey, can you get to 20? Just because it'll save you money, right? So 5 years is being vested or turning 65. 10 years is when you're eligible to start getting subsidized cost. 20 years is, as of today, the way the plan is written, the Medicare Advantage plan would be free. 30 years is a big milestone. So normal retirement for the pension plan is age 65. If you retire before 65 without 30 years of credited service, you'll get a pension reduction because that's considered early retirement. It's almost like 5% a year for every year you're shy of 65. So that being said, if you have 30 years and you wanted to retire at age 60, because you got your 30, you can retire early without a pension reduction. Okay. 25 years is another milestone that not too many people know about. Basically, what that means is when you have 25 years of credited service, you are forever active. And what that means is this: if you're working, earning credited service, you're active, and that's great. But let's say your job ends or you step away from the church for a while, then after a certain couple of months, you become inactive. If you are inactive, you lose some of the ancillary benefits that the pension plan provides. It's easy enough to become active again, but the point is you lose some of those benefits while you are inactive. And I could go into more details in a minute about that. But 25 years is, if you have 25 years of credited service, no more assessments are being paid, you still remain active. That's the importance of getting to 25 years, okay? So some of the benefits you would lose if you became inactive: life insurance. As of now, active clergy have life insurance built into the pension plan 6 times your salary, up to $150,000. If you become inactive, that goes away. Okay. At retirement, clergy are eligible for a one-time lump sum payment called the Resettlement Benefit. If you are inactive and retire in an inactive status, you don't get that Resettlement Benefit. Okay. And there are strategies we could talk about in a one-on-one conversation how you could, become active again and get the resettlement benefit. There's something called the pre-retirement survivor benefit option. So what that means is, let's say you're in your 40s, you're active, you're working, everything's going great, and then you get hit by the bus. We would assume that you would have continued working to age 65. You would have continued earning credited service, staying active. We would calculate what your pension would have been, and then we would give that to your surviving beneficiary. So we would be paying the assessments for you for those years when between when you got hit by the bus. So if you become inactive, you lose that. Another reason why you want to stay active. Okay. So what else can we talk about? If you find that your position ended, you can set up what is known as a between cures account. What that means is you are paying assessments on your own behalf to stay active while you're looking around for another position. You could do that for up to 24 months at a time, and you could do it as many times in your career as you need to. That's called a between cures account. Something else is called an extension of ministry. If you can't find a position inside the Episcopal Church, or you could find, let's say, for an example, a hospital down the street needs a chaplain, and you apply for that position. Now you're performing your ministry as a chaplain, even though it's outside the Episcopal Church. You could come to CPG and say, hey, even though I'm working outside the Episcopal Church, I'm still performing my ministry. I want it to count towards my pension. So in this example, as a chaplain, the committee here that makes these decisions probably say, sure, great, yeah. Who's going to pay the 18% assessment on your salary as a chaplain? If you can get the hospital to pay for it, that'd be fabulous. But in the real world, that doesn't happen too often. Or you might be able to negotiate, they pay half, you pay half. Or worst case scenario, you would pay the 18% assessments on your salary as a chaplain, but at least you're earning credited service, staying active, and all that other good stuff. So that's called an extension of ministry. Later on, when you get closer to retirement and you want to review your work history, there may have been gaps where you didn't get a full year of credited service. So there's something called a personal makeup account, where based on the rules of the time when that gap occurred, you may have the option of paying CPG in order to make that partial year a full year of credited service. So that would increase your pension. Okay. So I know I'm not talking about taxes so much at this point, but I'm wondering if anyone here, if there is a general topic that they want me to discuss with regard to taxes. We talked about how to determine housing allowance, how to designate it, how to calculate it, both active while working and also in retirement. We talked about business expenses and how an accountable reimbursable plan might be beneficiary to you. We talked about some of the more important pension rules about being vested and getting certain years of credited service. So we talked about checking Social Security accuracy every couple of years to make sure they have on record what you earned as a cleric. Oh, and as a sidebar for that, so let's take an example. If you are earning $60,000 a year, and let's say you're contributing $5,000 pre-tax to the RSVP plan, then that $5,000, because it's pre-tax, legitimately will not show up on the radar for Social Security purposes. So for that year, they should be thinking you made $55,000, because the $5,000 pre-tax legitimately doesn't show up on the radar. But if the numbers of Social Security are off by any more than that amount, then do the math and say, oh yeah, they forgot my housing allowance, and that's when you would go back and correct it. Okay. So in the beginning, we also talked about that 15.3% for the self-employment tax based on housing. So let me give you an example. Let's say you're declaring a housing amount of $20,000 for the year. So if you do the self-employment tax of 15.3%, that means the IRS is expecting you to be paying a little over $3,000 a year. To be precise, it's $3,060. So now, you as your taxpayer, you have a couple options on how to get that $3,060 down to the IRS. You could do what is known as estimated quarterly payments. Every 3 months, you write out a check, you fill out a little voucher you could download from the IRS website and mail in $765 every 3 months. So that by the fourth payment, you've got your $3,060 covered. Or you could fill out a W-4 form, W-4, which is an IRS document, and you could hand that to your employer to tell them, I'd like you to withhold an additional amount of tax out of my paycheck, so that the employer, in addition to taking the federal income tax on your salary, they'll withhold an additional amount out of your paycheck that will then get down to the IRS, and that'll cover you for that $3,000. So if you want to do that, bi-weekly, it comes to $118. Okay, so when you determine your housing allowance and you determine how much tax, self-employment tax you owe on it, you could either pay the estimated quarterly tax payments, or you could have your employer withhold more if they're agreed to it, bi-weekly or monthly, whatever, out of your paycheck by filling out that W-4 form to indicate to them how much more you want withheld to cover that amount. The idea is you got to get really close to the total tax owed at the end of the year, because if you don't by a certain amount, then the IRS will penalize you for underpayment of taxes. I don't know what, there's my picture. So I think at this point, I have covered everything. So if you want to stop the recording and we can go into individual questions, we can at this point.
Perfect. Thank you so much, Larry. That was so helpful. I know I feel a lot better prepared to go into conversations with my own tax preparer. I really appreciate this. I'm going to go ahead and stop our recording.